G'day YouTube and welcome back to the ASX Portfolio channel. My name's Jonathan. So today we're going to be talking about index funds, dollar cost averaging, and whether it's better to do a dollar cost averaging strategy or a lump sum investment. Now here we're going to be using Backtrader and actually testing on historical ETFs and index funds to see which strategies come out ahead. Now, first off, what is dollar cost averaging? Dollar cost averaging is the strategy where you invest a certain amount of money periodically into the market in a certain fund so that you can average into the market and then try and get the return of that line without committing all your capital up front. So what do I mean by lump sum investing versus dollar cost average investing? Well, let's say that you had $100,000 to invest 20 something years ago in the S&P market, as I have in this diagram here. Here, you would be placing all your money in back then, and then you'd simply leave it for that period of time, and then your return is based on the money you put in at the start and then where that product has got to over those number of years. Now, if you did not have all that money to invest at the start, as most of us don't, who earn an income and a monthly income, then one good way to try and actually achieve the same percentage return from a fund value perspective is to incrementally invest to approximate this line return. So as you can see in these diagrams, I'm showing as you increase the periodic investments that you make, you can actually start to approximate this line. Now, the more frequently you invest, the more accurately you approximate this line, and therefore the fund value return as well. Now, it's important to know that this is not the gross return that you're converging upon, but the actual percentage return of the money that you allocate into the fund with respect to the time that you place it in. So a little bit complicated, but today we're going to be showing the differences and how you can start looking at what strategy works best for you using Python. So we're going to verify all this using Backtrader. Backtrader is available here. Just type it in backtrader.com, and essentially it's a really good way to import data and execute strategies. So we're going to be using it here to evaluate whether the dollar cost averaging strategy is better than the lump sum value. Excellent. So let's get stuck into it. First thing you will have to do is pip install Backtrader if you haven't already. I obviously have, so requirement already satisfied. Cool. So let's start importing our dependencies. So I'm going to import datetime. I'm going to import math, import NumPy as MP, going to import pandas as PD, import matplotlib .pyplot as PLT, and then from pandas data reader we still need to import historical data and import Backtrader as BT. Awesome, so now we have our dependencies. We want to import the stock data that we're going to be looking at. For this tutorial, I'm going to be looking at the ETF, the index ETF, VTS. So this is a Vanguard product that tracks the S&P 500. So let's go ahead and import data. So we're going to define a function getData, and that's going to take the stocks we're interested in. It's going to take a start date and an end date. From there, we're going to return stock data, and we're going to make that equal to pandas data reader .get data Yahoo. So get underscore data underscore Yahoo, and we're going to give it the list of stocks. We're going to give it the start date and the end date. Excellent. Now that we've defined our function, let's define a list of the stocks. So I'll call it stock list. I only want to have VTS and it's .ax, the Yahoo product name. So for stocks, so now the end date. So the end date of this analysis, what we can do is just go call datetime.datetime.now. So we'll take it as today, and the start date we can evaluate at some period before this end date. So we'll use datetime.timeDelta and evaluate a number of days before. So let's just go 5,000 days. Awesome. Now for some of the ETFs that we will be looking at, really important to know that the actual start date may be well and truly after this 5,000 days before today. So we'll have to take that into consideration. So what we're going to do is we're going to get that stock data by calling our function. So, sorry, get data. I said date, get data. What we want is stocks 0. So we're only going to get that one stock in there in the stock list, and we want to evaluate that between the start date and the end date. So start date, end date. Excellent. So now, like I was saying, actual start, we want to ensure that if this product was only made in the last 2 years, that we're only going to get the actual start date that the product started. So what we need to do is just go call the stock data, call the index, which will be the settlement date, and just get the first index. So hopefully it's ordered in ascending order. So we'll just take the first one. So now for Backtrader, there's a couple things we need. We need to define a strategy, and that's defined as a class. So we need to define a strategy. We need to define the data source, and then we need to actually run the strategy with that data. And we actually need to run the entire script. So this is going to be our base template. So if name of this document is equal to main, then we want to run data. Awesome. Okay, cool. So first off, what we need is the actual data, and we need to put it into a form that that Backtrader can actually use. So for that, we've called Backtrader BT. So we're going to call BT dot feeds. So BT dot feeds, and we're going to say we're giving it pandas data format. Now we also need to specify that this data name is going to be stock data. So we're telling it, hey, we're giving you a pandas data frame of this form. So really important to specify what type of data and to actually put it in Backtrader feed form. But again, feel free to look at the documentation on Backtrader for more. So strategy. First one we're going to talk about is the buy and hold strategy. So for that, we're going to create a class. So we'll call this buy and hold. And we need to inherit upon a class, which is bt.strategy. So buy and hold. So there are a couple things that we need to define within this function. We need to define a start. We need to define what it does every step when it gets a new piece of information. So next start, we need to define what it does at the end. So define stop. And again, this is all within the documentation. So what do we want it to do when we're first evaluating this strategy? Well, we want the start value to receive the amount of money that we have to invest at the start. So we'll call this val start. And this is going to be the amount that the broker variable has in cash. And again, we'll define this down here later. So we're going to take the amount from self broker and call the get cash function. And this is going to give us the amount of value that we can start trading with. So what we want to say here is that in the next start variable, so as data starts coming in, we want to allocate all our cash in one block as much as we can and buy as much of this product as possible. So the way we're going to do that is we're going to define a size, so a number of units to buy, and then we're going to go self.buy, which is a Backtrader function, and we're going to define that size as size. So we're going to say buy this many units. Now the amount of units we want to buy is the maximum amount of units we could possibly buy with that money. So we're going to evaluate the floor of the amount of cash that we have divided by the actual price that we're going to trade at. So if we go self.broker.getCash, okay, and we're going to divide that through by self.data 0. So essentially this is taking our first data point, and we are making an assumption here that we are going to just buy at the close information. So that's a simple assumption. Obviously that's not going to happen in actuality, but because we're using daily information candlesticks here, it's not that granular anyway. So this is an approximation, of course. So one thing to take in mind here is that we're actually going to add commission. So it's really important here that we don't want to end up with a margining problem. So I'm just going to subtract $10 from this amount to ensure that we're always buying less than we can buy. If we were a bit unlucky and the price, the first candlestick that came in here, was exactly divisible by that number, then it wouldn't account for commission and then it wouldn't go through. So that's a bit of a pain with Backtrader, so I've just taken out the commission number there. So now the stop, what do I want to calculate at the end? Well, I want to calculate the actual returns. So calculate actual returns. So for this, I'm going to have the return on investment, so self ROI, and I'm going to call this this is going to be self.broker.getValue. So this function gives us the value that is in our account at that time, including cash. And we're going to divide that by the self.valStart. So we're taking the amount of money that we have at the end divided by the amount of money that we started with in our investment, and we're going to subtract 1 to get the return on investment. Now, to kind of print out some useful information, we'll just go print hyphen times that by 50. So to segment that off, and let's first say print buy and hold. So this is the buy and hold strategy. So print starting value, and the first thing we're going to print out is the starting value in cash. So we want to separate this by commas, maybe with 2 decimal places. We'll use format function and we'll take in our initial value. So self.valStart. Awesome. So we'll print out the ROI. And and we'll do that as a percentage. Dot format self.roi times 100. Cool. The next thing we'll do is we'll get the annualized percentage return. And at the end, we're also going to get the gross return as a dollar figure. So I know it's a bit confusing, but bear with me. Once you learn some of these functions, you'll pick up Backtrader fairly simple. So annualized returns, what we're going to do is we're going to take 100%. We're going to go 1 plus the self return over investment. So this is the cumulative return over that time period. And we need to take that to the power of 365 days divided by the amount of days that we actually have. Now remember, I've calculated the amount of days between the actual start date and the end date by just going end date minus actual start date. Remember, they might not be the same thing. And we need to actually call that days. So we're going to call the days component of that. Just making sure the brackets align, and then we need to minus 1. Excellent. Now the gross return's obviously very easy. All we need to do is get the value and subtract the value start. Great. Now, before we can run this function, we actually have to give the data and give this strategy to Backtrader. Cool. So let's get stuck into it. First thing we're going to do is call Cerebro. So Cerebro is the handler of Backtrader, really the backbone, and this is the class function that we're going to give our strategies to. So we're going to call Cerebro and bt.cerebro. Very easy. Now the things we're going to add to Cerebro is the data. So cerebro.add data, and that'll just be the data feed. We're also going to add the strategy. So cerebro.add strategy, and that is going to be this class hold and buy. So now that we've got that functionality working, excellent. So we've added the strategy, we've added the data. We need to add in broker information. Now, broker information, there's probably two things to this. First, we want to tell it that it can cheat by cheat on the close. So we want to say that it will always get the close price. So the way we can do that is we'll call this broker args. And we're just going to make a dictionary of this thing called COC, which stands for close, cheat on close, and we're just going to call that true. So the way that we can enable that is by calling cerebro.broker, and what we're going to do is make that equal to backbroker, and we're just going to unpack that dictionary, broker args. Cool, so we've just told it cheat on the close. Now the other piece of information, we want to define what is the fixed commission scheme that we want to add into this place. So for that, we actually have to define another class. So for example, if we're buying units of a particular fund, perhaps for Australia, if it's less than $1,000 brokerage through Commonwealth Bank, then it's $10. So you can obviously add in more complex commission schemes. But here, because for the dollar cost averaging strategy, we're going to be using parcels of $1,000, I thought that it would be best to do this fixed commission scheme for comparison. So all we need to do is take some parameters. So we're going to define commission, and that's going to be equal to 10. We're going to define stock-like characteristics. So we'll call this parameter true, and we're going to say the com type is going to be bt.com info base, which is just taken from up here, and we're going to say com fixed. So we're taking a fixed commission for each trade. Awesome. Now that we've specified those parameters, we just need to specify or override this function, and we're going to call it get commission. Now this is important because this function is going to be called while executing the trades in Backtrader. So this takes size, price, and pseudo exec, and all we need to return here is the self.p.commission. So if it was dependent on any of these other inputs, then you could obviously change the commission scheme for there. We could say that if the value, the size and the price was greater than 1,000, then it's X amount of dollars. But let's just keep it simple and keep it $10 for now. Cool. Okay, so we've got a fair bit there at the moment. Let's now add that brokerage scheme in. So let's say com info is equal to this fixed commission scheme class, and we just need to go cerebro.broker.add commission info, and we'll add this class com info. Cool. So we've added cheat on close, we've added the commission info of $10. The only thing we need to specify now is how much money we're starting off with, and for that all we need to do is cerebro.broker again and set cash. So for this we're going to start off with 100,000. Cool. Final piece of the puzzle is we need to call cerebro.run, and we're going to plot the output. So that takes iplot false, and style, I want a candlestick graph. So I'm conscious that you haven't seen any outputs yet. We really need to get this base bit of the code done before we started anything. It's concerning me that it hasn't imported that yet, but maybe it's just not recognizing the module. As soon as I run it, Python ETF. Excellent. Specify missing precision. I think I've just placed the dot there before the comma. Excellent. Great. So what you can see here is that now I have this graph. And this graph is obviously the time series that BTS, this ETF, has been going all the way since the beginning. So the beginning there was 2009 June. As you can see, we've invested $100,000 straight up. And you can see here that we've got a return on investment of 373%. Annualized, that seems a little bit funny considering it's that period of time. So forgive me here. As you can see, the annualized line was completely incorrect. I missed the brackets here at the 100, and this isn't divided by 100 at all. That's already as a straight cumulative percentage. So as you can see, we've invested once, we placed $100,000 in approximately, and we've got an annualized return of 13.68%. This has given us a gross return over 12 and a bit years of $373,000. Cool. So now what we're going to do is we're going to compare this annualized percentage and how it can change by investing monthly a certain amount of money. So now that we see the capabilities of adding a strategy, we just need to do the same thing, but continually add more. So let's make a change. Well, let's make a new class, and we can copy this one, might help us a little bit, and we'll call it buy and hold more for a fund. So picture this now is going to be like your superannuation strategy, where you continually invest a certain amount of money over a frequent period that you define. So we're going to have some parameters. So this is going to be a dictionary, and the two parameters we're going to have is monthly cash invested. So let's say $1,000. And then we also need, or let's say monthly cash, and then we'll call this monthly range. So how often do you want to invest this $1,000? So really every time we invest, we're going to have $1,000 to invest. How many times and which days do you want to do it? Well, let's say I want to do it twice a month, on the 5th day and the 20th day. Now, if these aren't trading days, we're going to be able to take care of that later in the code. So I want to initialize some parameters here because I want to keep a track of some things. So the way we can do that is we'll call the init, we'll have self, and we're going to define some self parameters. Now I want to do this so I can keep track of orders and the total cost and cost without brokerage and things like that. So self.order is going to be equal to none self.total cost. So this will be the total cost that we've invested over time. It's going to start off as 0. We're going to call this cost WO, so without bro. Accumulated cost without brokerage, self.units, so the number of shares that we have. Now you could let the system calculate all this yourself, but it's nice to reassure that you're doing things correctly. So we're also going to calculate the number of times that we invest. Now I want to create this function called log, and this is going to be cool because we're going to be able to see when we transact and how much and the type of the brokerage and things like that. So let's call this log. So we're going to call this self. We're going to have text and a date time parameter. So this is going to log for this strategy. So what I want to have is dt equals dt, or self.datas. So this is going to take the data frame that we're dealing with right now, whether it's the traded candlestick or whatever, when it's evaluated in the system. And we're going to take the date time of that data stick. So we're either going to define it or we're going to take it from the candlestick information. What do we want to print? Well, we want to print the text information. So the way we're going to do that is specifying %s and %s here. And we're going to fill those values with dt.iso format for the date, and then text. Cool, so now that we have this log functionality, that's going to be really, really useful. Changes that we're going to make to start. Now, start is what happens, remember, when we activate this strategy. So we need to take the broker amount, so that's still pretty handy. So we're going to call this val start. Instead, we're going to call this cash start. Now, it's really important to understand that the true percentage return, the gross percentage return, is actually going to be different here. But there is something called a fund mode, and this is how fund managers evaluate the percentage of return that you're getting on the actual money invested into the product. So we're going to use some tricks here. I can explain it more later, but it is documented here on the website, and I'll point you a link into the description. So we're going to call this set fund mode. So the fund mode is going to be set to true, and the fund start value, is going to be 100. So what this is going to do, this is going to base everything in terms of, it knows that we're going to be giving it money every month or periodically, and we want it to only evaluate percentage returns based on the money that it has right now at that time period. Val start. So I want to evaluate the starting point for this fund at 100. Cool. So the thing that's going to be really necessary is that we need to add a timer. So this timer here is crucial to our strategy, and the things that we need to specify is when we want to execute information, the month days, so which days do we want to execute, and the month carry. So if that was a public holiday, weekend, whatever, then what do we want to do? We're going to give this a timer name, and we're going to call it a buy timer. Cool. So first off, when do we want to actually call this timer? Well, essentially, I want to use this timer information at the session start. So we're going to call the timer at the start. The month days we're going to call is I for I in the self.params. So to call the params, you go self.p, and then we can call this monthly range. So we want to define the parameter up here so we can change it later. For the month carry, if one of those days, so the 5th of August or the 20th of August was a public holiday or a weekend, then we want to say month carry equals true. What this does is that it will take the second day after that if it's a public holiday or a weekend. Cool, so we've added a timer. Now we need to specify this thing which says once we've called the timer, what does it do? And this is called notify timer. So this is going to be in comparison to next start. So instead of having next start, we're going to call this notify timer. Cool. So this is going to take self timer when, and it could take some args if we wanted to. First thing we're going to do is we're going to add broker cash. So self.broker add cash. So every time that this time is called, twice a month, we're going to add self.p parameter, the monthly cash value that we've defined. So monthly cash. So we're going to add this amount to our brokerage account. Now, with that added account information, we need to come up with some kind of target value that we're going to invest. So this will be the accumulation of our account, self.broker.getValue. So this gets the entire value of our account plus this money invested. So what is the value right now plus the money we're about to invest? Now, I'm going to subtract $10 because of the commission, and we never want to get something that accidentally can be divided exactly by the price number, and then we end up getting that amount of shares but can't pay for brokerage. So I'm adding brokerage here just so we don't get any margin errors. So I'm going to use this thing called an order target value. So what this does, instead of just buying a certain percentage at a price or a certain number of units of shares at a price, this will try and target this target value that we're giving it. So I want to invest this amount of money and buy a number of shares that's going to be equivalent to the amount of cash on deck plus the total value of my account. But in actuality, of course, you're only going to be buying how much your monthly cash value allows you to. But these are the quirks that we have to live with for Backtrader. Cool, so once we've used the notify timer, we then can go down to the stop. So for the stop, we want to evaluate the self ROI again, and this is going to be the same thing, but instead of the val start, remember I did change that to cash start. So that's okay. What I do want to now term is something called the fund return ROI. So the fund ROI. Now this is going to be the broker get fund value. And what we're going to do is we're going to subtract the value that we had in that fund at the start, which is going to be 100. So this will give us the direct percentage return of the actual fund value, so the amount of money in the fund, considering when we gave the fund that allocated cash, what is my return on value of all those incremental cash increases? So we're going to call this strategy buy and buy more. So please forgive me, I'm going to copy this section just because I think it's going to be a little bit tedious for you, and you can just copy off my website or copy directly here. So feel free to pause the video and copy these in from my website. So I'm going to define this thing called the value, and this is going to be the self.data's last close information there. I'm going to multiply it by the self.units, which we haven't actually added yet, and self.broker get cash. So I want to add my value in my account and my cash together. Cool. What I'm trying to return here is the time that I've had in the market, as a number of years, the times I've invested, the value, the cost that it's actually had on me, the gross return in terms of the value that I have right now, minus the cost, the gross percentage, the ROI, which you'll see is the return of the initial invested capital, which is absolutely rubbish, and then the fund value ROI. You'll see why that's so important there as well. I've then annualized this fund value ROI over this period of time. Cool. Now, the piece of information that we're missing is that we need to add the amount of units as we start transacting and buying pieces of the fund. So what we need to do here, under notify timer, we'll call a function notify order. So what's this going to take? This is going to take self, this is going to take order. So if order, so when we place an order, it's going to come into this function here. Now, if the status of this order is in one of these two categories, submitted or order.accepted, then what I want to do is nothing. It's still going to handle the accepted order or the submitted order. What we need to do is just return nothing. So it's still processing. If, however, this order has been confirmed, so if order status is in order.completed, then what we need to do is if order dot is buy. So if this is a buy order, then what I want to do is I actually want to log that we've bought it. I want to know what the price is, what the cost was, the commission, and the size that we're buying. So I can use my self.log function, which is pretty awesome. And we're going to give it text, buy executed. We'll give it a price. We'll give it a price, which is going to be .2f. We'll give it a cost. We'll give it commission. And we're going to give it a size. Cool. So let's define those parameters. They're all going to come from order executed variable. So it's going to be order executed price, order executed dot value, order executed dot com. So commission with 2 M's and order executed dot size. So this is going to log all that information for us, which is pretty nifty. Things that we want to actually be updating in our variables here. So every time that we do transact, we want to add the number of units to our portfolio. So we'll call this the order size. So add order size information, keep incrementing that. We want self.total costs plus equal to the order value. We want the self.cost without brokerage. So all this is going to be is the order executed value, but in the total cost, we're going to add the order executed commission. Awesome. Now the times that we invest is just going to be plus or equals to 1. Cool. So now there are some edge cases. What happens if this order did not complete? So let's go else if order.status, okay, is in one of these categories. So the other categories there are cancelled, there's order.margin, which I promise you you're going to come across on, and then order.rejected. Cool, so we're going to do self.log here as well, and all we're going to say is order was cancelled or margin or rejected. So it's just going to indicate that it was one of these things. To identify which one it was, what I can do is I can go print order.status, which will give me a number, and then I can compare those numbers to this ordered list and define whether it was cancelled, whether it was margin problem, or whether it was just rejected. Then you can investigate a little bit further. So at the end of each of these functions, you have to make sure that you make the self.order variable equal to none. Awesome, so we're notifying orders. What we need to do now is add this strategy down into the bottom. So this is going to be our buy and hold strategy. If we copy and paste that now, buy and buy more. So we'll call this Cerebro 1. So here we're buy and hold more fund. We'll be adding the same brokerage. We will start off with $1,000 in this account. We're going to run this and I want to plot this graph. So just change the order of when this is executed. I'll copy and paste that and place it underneath. So I'm going to run the first one. I want to plot that information and then plot our increments after. Cool, so let's clear this. Run the information. Cool, so I'm just going to get rid of that timer name there, by timer. That wasn't liking the fact that we'd actually defined that timer. And then obviously making sure that that set fund mode is correct. Now you should be able to let this rip. You can see all our executed buys have been printed. Now the first one we're printing out is the buy and hold strategy. So as you can see, we've invested $100,000 here and we have an annualized return of 13.68%, which is pretty good. We can see that the time in the market is 12.1 years, and we've got a gross return of $373,000. Now, as you can see, with the averaging in every buying twice a month, $1,000 each, over the 12.1 years, we've invested 245 times. Now, each of those values is about $1,000, including the initial $1,000 value. We have some cash left in our account, which is okay. And don't forget that we've added brokerage in each of these times. So the gross return is about $423,000. So mind you, over this period of time, we've invested $245,000 into the market, and we've got a larger gross return. Obviously, we have put in more money, fair enough. Interesting part about this is that our gross return is much less than the ROI of the buy and hold strategy. Now, this is expected because we're averaging into the market. As the market goes up, we're increasing the average price that we've actually invested into the market and therefore reducing our overall gross return. That's okay. Why do we need to do this? Well, we don't have all the money right now. Our equity curve, for myself and probably a lot of you out there, is that you start off with not a lot of money at the beginning of your life and you start increasing the amount after you graduate or finish school, and you start getting a job. Your wealth increases over time, and then up until a certain period of time, your wealth is increasing and you would like to invest over that period of time to try and find things that can return cash to you, or give you a rate of return higher than you expect into the future. When you're then older and you want to retire, you then want to lean on these funds and these investments so that you can then sell them off gradually and live off that invested capital. So, therefore, this buy and buy more strategy is probably what you're going for. So dollar cost averaging is a really good strategy. Some things to note: that this is a really long time period. You can play around with the time periods, you can play around with brokerage, you can play around with the investment period and the amount of money, play around with the commission and how they affect the two. Really useful to kind of gauge how much commission is actually impacting your results here. The convergence of this annualized percentage, I'll reduce my time frame here and we can just take a look at that. Let's say that I was only investing for 450 days. So over a year and a bit, 1.2 years. You can see here now that the annualized percentage difference is actually lower for the monthly trading strategy. Why is that? Well, sometimes you could be lucky and it could actually be higher because you've invested at the bottom of the trend, but yeah, pretty unlikely. This annualized return will converge as the commission goes to zero. And as your frequency of trades increases and the commission goes to zero. That second point is really important. So getting this fund return close to the actual annualized return that you'd get if you just invested all your money up front is really crucial. So how much money have we invested here in 1.5 years? We've invested $23,000. Cool. So let's try and invest the exact same amount of money as the $100,000 that we're starting with. Cool. So here that's cost us 55,000. Let's do 18,000. 1800, sorry. Bang, we've hit it smack on the head. So here you can see that we've invested $102,000, so just over $100,000 over that period of time by dollar cost averaging. You can see that the gross return here is $52,860. Now that is a lot less than the gross return of this buy and hold strategy. Why? Because when we put all that money in at the $100,000 down here, this has time to compound. It's been invested at this annualized return for that entire period of time. Whereas this fund value return, this annualized return, is calculated on the basis that you don't have all that money right now and you only have it when it's placed in the fund. So therefore, obviously your gross return is going to be less, but comparably, not many people have this amount of money, especially at my age, to invest right now. If I did, obviously, investing in the market right now, given the historical trend of the S&P 500, is probably a pretty safe investment time horizon. Then you could invest everything right now, and obviously you might be very happy for it in the next 80 years. However, if you're like me and you just have a monthly income and you want to come up with some kind of strategy and frequency that you can just continue dollar cost averaging in, you can actually converge on this annualized rate of return, fund return, exactly the same as the buy and hold strategy. Pretty important, and that's the benefits of the dollar cost averaging strategy. Just keep in mind that obviously you need to account for brokerage, which of course Backtrader can help you do that. And dollar cost averaging is just a great strategy for those who have a monthly income and need to allocate your capital as your equity curve goes up during the investing stage of your life. So hopefully you learned a lot from this today. Hopefully you can use this code, change obviously the stock or the ETF that you're looking at. I'll just give one comment on the ETF. Obviously ETFs aren't a perfect replication of the index. Obviously, to get a true index, this has been rebalanced by the portfolio holder. So what they do is they set up a trust and they put shares into this trust. They then create ETF units, which then we get to buy on this secondary-like market. Now, sometimes there is a value difference between the ETF units and the value in the trust that actually holds the stock. But because this has been, I guess, the idea about ETFs and managed funds has been around for so long, a lot of the big players identified this arbitrage long ago. So this is really kept to a minimal. As you've probably seen Michael Burry and other investors on YouTube, a lot of people are talking about it right now, is that the risk associated with ETFs is really large. Why is this? Because it's a product. Really important to understand that these ETF units are linked to this trust that actually holds the unit value. Now, if you were a very large investor and you buy a certain amount of these ETF units, if you were able to buy one of these ETF units, then you would actually be able to ask the fund to liquidate this into shares, and therefore you would cancel out the actual ETF unit and those shares would be transferred to you. Now that would be awesome, but obviously I'm not at a scale that, or retail investors aren't usually at a scale where they can do that. So they will sell their investment at the end. But it is important to understand that this is just a product, and if demand for this product changes drastically, so suddenly tomorrow this whole stock market goes down by 80%, there might be a run on this particular product, on this particular ETF, and then you could see that the value between what's actually in the stock trust versus the ETF units could be in trouble. So a market maker trying to control these two, there could be a large divergence, and this is the big risk that you have with ETFs. So hopefully you got a lot of value. If you really like the video, I'd appreciate if you gave this video a thumbs up and subscribe for future content. See you next time.